If you study every major financial crisis of the last 100 years, a clear pattern emerges. The most critical warning signs always appear roughly 90 days before the breaking point. 90 days when liquidity begins to tighten, credit quietly deteriorates, and institutional behavior diverges from public sentiment. 90 days when the surface remains calm while the foundation silently weakens. The truth is simple. By the time the world realizes a collapse is happening, the real collapse began 3 months earlier. Before we go deeper, take a moment to subscribe, leave a comment, and hit like if you want more deep, analytical breakdowns just like this. It helps this message reach more people who need to understand what's coming. Understanding the 90-day window requires thinking like someone who has lived through cycles, not just studied them. After more than 20 years in finance, one lesson has repeated itself. Markets disguise fragility inside stability. Investors see rising stocks and low unemployment and mistake that for safety. But collapses never begin with falling markets or high job losses. They begin with deterioration in the parts of the system most people never notice. Funding markets, credit spreads, liquidity depth, corporate refinancing behavior. These are the first places stress appears. And during the final 90 days before a crash, these indicators shift long before anyone outside the financial world understands what is happening. Look back at 2008. Long before Lehman Brothers collapsed, the real warning signs were already visible. Mortgage delinquencies surged quietly months before, credit default swap spreads widened, interbank lending tightened, and volatility indicators behaved abnormally. Yet the public saw none of this. Headlines still called the economy strong. Politicians insisted the system was healthy. Investors continued buying homes. The fragility was obvious, but only to those watching the right metrics. The same pattern held in 2000, in 2020, and in 1929. The system warns early, but softly. The modern economy is even more vulnerable because it is built on liquidity dependence. Liquidity is the bloodstream of markets. Most people never think about it, but liquidity determines how easily institutions borrow, how fast they can move money, and how stable leverage positions remain. When liquidity tightens, even slightly, everything changes. Borrowers struggle to refinance, banks become cautious, hedge funds reduce leverage, and market depth thins. These changes don't appear in mainstream financial narratives. They appear in repo markets, treasury liquidity metrics, overnight funding rates, and credit spreads. If you know where to look, you can see the 90-day window begin long before the public feels anything. A collapse feels sudden because stress moves faster than sentiment. Sentiment, what the public believes, always lags the underlying data. Households continue spending, investors remain optimistic, and corporate executives keep expressing confidence, all while the mathematical structure of the economy quietly shifts into danger. In every major downturn, this disconnect defines the early phase. In 1929, as funding markets tightened, newspapers still celebrated record stock prices. In 2008, even as banks hoarded liquidity, analysts on television talked about soft landings. In 2020, credit markets flashed warnings weeks before lockdowns created panic. And today, the same behavior is visible. The public believes conditions are stable even as leading indicators warn otherwise. One of the earliest signs inside the 90-day window is a change in corporate refinancing behavior. Corporations know the credit environment better than almost anyone. When executives sense tightening conditions, higher borrowing costs, falling liquidity, or elevated risk, they move early. They refinance debt before maturities, extend credit lines, cut discretionary spending, and build cash reserves. These actions are quiet but meaningful. In the months before the 2008 collapse, corporations began hoarding cash despite strong earnings. In 1929, businesses reduced inventories long before the market crashed. Today, we see similar behavior. Companies refinancing earlier than needed, pulling back on expansion, and preparing for higher rates. These are not emotional decisions, they are structural ones. Yet the deepest and most consistent signal of the 90-day countdown is liquidity stress in funding markets. Before every major crisis, funding markets are the first to break. In a healthy economy, funding is cheap and abundant. In a fragile economy, funding becomes tight and unpredictable. This appears in repo rates, treasury market depth, dealer balance sheet capacity, and interbank lending conditions. These metrics were the first to crack before the Great Depression. They were the first to crack before 2008. They showed strain in late 2019, months before COVID became a global shock. And whenever this tightening begins, the 90-day window has started. What makes the 90-day danger zone so deceptive is the conflict between lagging indicators and leading indicators. The public focuses on unemployment, GDP growth, and corporate earnings, indicators that lag reality by months. Meanwhile, leading indicators begin to weaken. Credit spreads widen, yield curves invert more deeply, liquidity evaporates in small pockets of the bond market, and household financial stress increases. During this period, the average person sees nothing wrong. News anchors talk about soft landings. Investors become complacent. Policymakers insist the system is resilient. Yet beneath the surface, the pressure is building. One of the clearest behavioral markers is the divergence between institutional and retail activity. Professionals begin reducing exposure, hedging risk, or repositioning into safer assets. Retail investors often do the opposite. They double down, convinced that dips are buying opportunities. This exact divergence occurred before the dot-com crash, before the 2008 crisis, and even before the sharp drawdowns in 2022 and 2023. Institutions move quietly. Retail moves emotionally. The 90-day window is defined by this widening behavioral gap. The final element that defines the countdown is the nature of catalysts. A collapse never begins because of the headline event people remember. That event is only the trigger. The system collapses because it was already fragile, already over-leveraged, already dependent on liquidity, already stretched thin. The trigger merely exposes what was hidden. In 1929, the catalyst wasn't one bad day. It was the cumulative impact of years of debt-fueled speculation meeting a sudden liquidity shortage. In 2008, it wasn't Lehman. It was the entire mortgage market being structurally unsound. In 2020, it wasn't the virus. It was a financial system already experiencing liquidity stress. What makes the modern era unique is the speed. In the 1930s, crises took months to fully unfold. In 2008, they took weeks. Today, with algorithmic trading and global capital flows, a collapse can accelerate in hours. The interconnectedness of modern markets means that once the 90-day window ends, the chain reaction is faster, wider, and more violent than anything from previous eras. And yet, the 90-day warning period feels normal while it's happening. There are no sirens, no flashing lights, no dramatic headlines, just small anomalies, tiny cracks appearing in the most sensitive parts of the system. Only after the collapse does everyone look back and say, "We should have seen it coming." But the truth is, the signs were always there. Quiet, precise, mathematical. And if history is right, the next 90-day window may already be forming. To understand what truly happens inside the 90-day window before an economic collapse, you have to examine how the financial system behaves under growing stress. While the general public focuses on stock market movements, the real warnings appear far earlier in the plumbing of the economy, places so technical and obscure that most people never notice them. Yet these hidden signals are the first to reveal that the foundation is shifting. In every financial crisis of the past century, the earliest signs emerged not in equity markets, but in short-term funding markets, corporate credit spreads, interbank lending, and the liquidity behavior of large institutions. The 90-day window is when these quiet movements become unmistakable to professionals watching carefully. One of the clearest early warning signs in the 90-day window is a disruption in the behavior of treasury markets. The U.S. Treasury market is the backbone of global finance. It is supposed to be the most liquid, stable, and reliable market on Earth. When treasury liquidity deteriorates, wider bid-ask spreads, declining depth of book, inconsistent pricing at auctions, it signals that something fundamental has shifted. These issues appeared before the 2008 crisis, before the 2020 liquidity shock, and even before the mini-crisis in late 2023 when volatility in long-duration treasuries spiked unexpectedly. Treasury instability signals fear among institutional players who typically rely on treasuries for collateral, liquidity, and hedging. When the safest asset in the world becomes harder to trade, it tells you confidence is weakening at the core of the system. The next signal emerges in the corporate bond market. When investors start demanding higher yields to hold corporate debt relative to government debt, it reveals a rise in perceived risk. This widening of credit spreads often appears subtly at first, then accelerates as the 90-day window unfolds. Historically, credit spreads widen long before equities fall. Before the dot-com crash, credit spreads began rising months ahead. Before the 2008 meltdown, spreads widened dramatically while stock indices were still near their highs. Today, elevated spreads in riskier corporate categories, combined with a significant refinancing wall approaching in 2026, indicate growing stress. When companies face higher interest rates to refinance debt, their cash flows weaken, profit margins tighten, and eventually, layoffs and spending cuts follow. This tightening cycle almost always begins within the 90-day countdown. Another structural sign is the weakening of market depth. Market depth measures how much buy and sell liquidity exists within close price ranges. In stable environments, depth is strong. Large buy and sell orders can be absorbed easily. During the 90-day window, depth declines. Fewer participants are willing to take the other side of trades, spreads widen, and volatility increases without external catalysts. This phenomenon was witnessed in late 2007, when market depth deteriorated even while stock prices remained stable. It appeared again before the 2020 shock, when liquidity in major asset classes quietly thinned. Today, market depth in key areas, treasuries, corporate credit, and even certain equity sectors, has shown intermittent weakness, a classic sign that sophisticated players are preparing for turbulence. Institutional behavior offers another powerful indicator. When the economy approaches the 90-day danger zone, major financial institutions shift strategies. Hedge funds begin reducing leverage, not because of market declines, but because their internal models detect rising correlation risks. Banks tighten lending standards, particularly for high-risk borrowers. Private equity becomes more cautious in deal-making. Venture capital firms slow investments. These moves are not dramatic enough to become headlines, but they are meaningful. Institutions operate on forward-looking data. When they pull back, it means conditions beneath the surface have changed. Before the 2008 crash, large institutions reduced exposure months in advance. In 2023 and 2024, similar behavior began emerging, particularly around private credit and commercial real estate. One of the most overlooked but important signs within the 90-day window is stress in the consumer sector. Consumers are the foundation of the modern American economy, and their financial health reveals deeper truths about systemic stability. Within the 90-day countdown, delinquencies begin rising, not in obvious ways, but in specific categories like subprime auto loans, credit card debt, and buy now pay later obligations. These categories represent the most vulnerable households, and their struggle is an early signal that economic pressure is reaching critical thresholds. Rising delinquencies were among the earliest signs of stress before the Great Recession. Today, delinquencies across multiple consumer segments are at their highest levels in more than a decade, even while headlines claim the economy is strong. Employment data also gives subtle clues during the 90-day window. Contrary to popular belief, collapses do not begin with mass layoffs. Instead, layoffs begin in smaller, less visible sectors: temporary workers, contract labor, low-margin industries, and discretionary consumer categories. These early job losses do not push unemployment rates higher immediately, so the public barely notices them. But to a trained eye, these small shifts reveal tightening economic conditions. In the months before the 2008 collapse, job losses began in housing-related sectors well before the broader labor market broke. In the lead-up to the 2001 recession, tech sector layoffs began quietly before the bubble burst. Today, early layoffs in retail, logistics, and smaller tech companies mirror those historical signals. During the 90-day window, volatility behaves unusually. Instead of consistent, predictable movements, markets experience sudden spikes followed by rapid declines, microbursts of volatility without obvious news catalysts. These volatility anomalies reflect thinning liquidity, higher uncertainty among institutional traders, and the withdrawal of algorithmic liquidity providers. In a stable market, volatility responds to new information. In a fragile market, volatility appears even without news. This is exactly what occurred in late 1929, early 2000, late 2007, and early 2020. The pattern is unmistakable. The housing market also sends early signals during the 90-day countdown. Although housing reacts more slowly than financial markets, the initial cracks appear in mortgage applications, declining buyer demand, and rising inventory. These changes happen months before price declines become visible. In the months leading up to the 2008 crisis, mortgage originations fell sharply even as home prices were still rising. Today, declining affordability and rising mortgage delinquencies represent similar early cracks. When housing softens, consumer confidence weakens, spending slows, and the broader economy becomes more vulnerable. Another important component is global capital flow. In the 90-day window, foreign investors often reduce exposure to U.S. assets subtly but consistently. This withdrawal may appear as declining demand at treasury auctions or increased hedging activity among foreign central banks. These signs indicate falling international confidence in the stability of U.S. markets. Before the 1997 Asian crisis, foreign capital fled local markets months in advance. Before the 2008 crisis, foreign investors reduced exposure to U.S. mortgage securities long before the domestic public understood the risk. Today, several global indicators suggest declining foreign appetite for long-duration U.S. debt, a potential precursor to broader instability. The psychological environment during the 90-day window is one of misplaced optimism. The public sees strong job numbers, steady stock markets, and confident corporate messaging. Investors view pullbacks as buying opportunities. This confidence is exactly what allows the countdown to continue unnoticed. Meanwhile, professionals see a different picture: declining liquidity, rising credit risk, early stress in consumer finances, and unusual behavior in volatility markets. This divergence in perception accelerates the fragility. The 90-day window also intensifies the concentration of risk. As institutions grow cautious, retail investors often move into fewer and fewer assets, usually high-profile technology stocks or trending sectors. This concentration increases systemic vulnerability. In 1929, excessive concentration in a small set of industrial companies worsened the crash. In 2000, concentration in tech stocks magnified the collapse. In recent years, concentration in a handful of large tech companies has reached historic levels. When too much capital depends on too few assets, the system becomes sensitive to small shocks. One of the most striking features of the 90-day period is the failure of traditional risk models. Value-at-risk models, volatility forecasts, and correlation matrices begin performing poorly. They underestimate future risk because they are calibrated on past stability, not future instability. This model failure appeared before the 2008 collapse when banks misjudged mortgage risk, and before the 2020 shock when volatility models underestimated pandemic uncertainty. During the countdown, professionals adjust their exposure manually, relying less on models and more on experience. This shift from quantitative to intuitive decision-making is a hallmark of approaching instability. Ultimately, the 90-day window is defined by a single truth: collapses are not spontaneous. They are structural outcomes of long-term imbalances meeting short-term triggers. The countdown begins when liquidity weakens, accelerates when credit deteriorates, deepens when institutions reposition, and becomes inevitable once sentiment and fundamentals diverge completely. The danger is not in the trigger. It is in the system's inability to absorb that trigger. And by the time the countdown starts, the system has already lost its resilience. The final phase of the 90-day window, the moment just before an economic collapse becomes visible, is defined by accelerating contradictions. It's the point where the data and the public narrative no longer align, where optimism persists even as the underlying architecture of the economy enters a state of acute stress. In every crisis I've lived through or studied over the last 2 decades, the last stretch of this window feels deceptively calm to the average person while simultaneously feeling unmistakably tense to those tracking structural indicators. This tension emerges because the system has reached a point where small disruptions can trigger outsized reactions. The pressure has built for months, sometimes years, and now the fragility is so severe that any catalyst, even a minor one, can push the entire structure off balance. One of the most revealing characteristics of this final phase is the sudden shift in market behavior without any clear news event. Markets begin to oscillate in sharper patterns, reacting disproportionately to ordinary developments. A routine economic report generates unusually large moves. A standard corporate earnings miss triggers outsized sell-offs. A political comment sends volatility spiking. These exaggerated reactions reflect a market where liquidity has thinned enough that normal fluctuations cause instability. In a system where liquidity is strong and confidence is high, markets absorb shocks easily. But in the final stage of the 90-day window, market depth is so shallow and investor confidence so fragile that even moderate surprises produce sharp ripple effects. This is often the moment when professionals begin telling each other, quietly, something is wrong. Another hallmark of the final stretch is the rapid compression of credit availability. Lenders tighten standards with surprising speed. Credit officers become more conservative. Banks quietly reduce exposure to riskier borrowers and industries. These changes aren't accompanied by dramatic announcements. They appear in small but significant policy shifts: lower loan limits, reduced credit lines, higher collateral demands. To the public, the economy still looks fine. To institutions, the risk environment has changed. This rapid contraction in credit accelerates the countdown because once credit tightens, the real economy begins to slow. Businesses postpone hiring and expansion. Households face more pressure. Cash flow weakens. These effects take time to show up in economic data, but the structural damage begins immediately. During this final countdown period, companies often issue subtle warnings. CFOs mention uncertainty more frequently. Earnings calls include cautious language about future demand. Firms reduce capital expenditures and delay long-term projects. Large corporations begin preparing for a downturn even if they don't expect one publicly. The same behavior appeared in 2007 when corporate executives signaled concerns about credit markets even as stock prices reached new highs. In 2000, tech companies hinted at slowing demand before the broader market understood the implications. Today, many corporations have started adopting more defensive financial strategies, accumulating cash, reducing leverage, and lowering growth expectations. These are not panic moves. They are structural adaptations to weakening conditions. What makes collapses feel sudden is the way sentiment still lags the underlying conditions in this period. Consumers continue to spend based on past confidence. Investors believe markets will stabilize. News cycles remain focused on short-term political developments rather than economic fragility. This misalignment between perception and reality creates a scenario where the public is taken by surprise when the collapse becomes undeniable. It's not that the signals weren't there. It's that they were ignored or misunderstood. The final 90 days are always the moment when the system is quietly telling the truth, while the narrative continues to lie. In this final stage, markets become increasingly sensitive to liquidity shocks. Any event, whether economic, political, or geopolitical, can accelerate the unraveling. A bank failure, a currency shock, a policy mistake, or an unexpected financial disclosure can ignite widespread fear. The important thing to understand is that the catalyst is never the cause. It is simply the trigger that interacts with pre-existing fragility. Before the Great Depression, it wasn't a single headline that crashed markets. It was years of speculation, tightening credit, and declining liquidity that made the system vulnerable to even a small disruption. Before the 2008 meltdown, it wasn't the fall of Lehman alone. It was the complete fragility of mortgage-backed securities and over-leveraged institutions. In 2020, it wasn't only the pandemic. It was a financial system already stretched thin by fragile liquidity conditions. The next defining feature of the final 90 days is correlation spikes. Markets that typically move independently begin moving in unison. Stocks, bonds, commodities, and currencies all react to the same events simultaneously. This loss of diversification marks the moment when systemic risk takes over. In normal conditions, different asset classes respond differently to news. In fragile conditions, everything becomes connected and risk spreads instantly. This correlation spike appeared in late 2007, when virtually every asset class began moving together. It surfaced again in March 2020 when global markets reacted uniformly to every announcement. Today, increasingly synchronized market movements suggest rising levels of systemic interconnectedness, another classic sign that the countdown has entered a critical phase. During the final stretch, policymakers often make confusing or contradictory decisions. Central banks send mixed signals about interest rates. Governments release inconsistent economic forecasts. Regulatory authorities become more vocal but less effective. These actions aren't random. They reflect internal uncertainty and the growing difficulty of managing a fragile system. In the lead-up to the Great Depression, policymakers tightened credit at exactly the wrong moment. Before the 2008 crisis, authorities underestimated the severity of liquidity stress. Before the 2020 crash, policymakers misread the fragility of credit markets. Today, similar dynamics are appearing: conflicting statements, uncertain policy paths, and a visible struggle to balance inflation, growth, and financial stability simultaneously. These contradictions deepen instability. As the final days approach, retail investors often become more active. Social media-driven trading increases. Speculative behavior returns. Retail sees dips as buying opportunities. Institutions, on the other hand, exit risk quietly. This divergence between retail enthusiasm and institutional caution is one of the clearest signs that the system has entered its last stage of stability. It happened before the dot-com crash when retail traders piled into overpriced tech stocks while institutions pulled back. It happened before 2008 when households continued buying homes despite rising institutional fear. It happened before the meme stock mania, which preceded broader volatility. This divergence is a consistent feature of collapsing cycles. In the very last days of the countdown, liquidity fractures become obvious. Bid-ask spreads widen dramatically. Trading volumes shift unpredictably. Price swings intensify. Funding markets show signs of stress. The system becomes hypersensitive. Professionals in finance can feel the change, even if they cannot see the exact moment of collapse. In these final hours, the collapse is not a possibility. It is an inevitability. All it takes is a spark. When the collapse finally becomes visible, it appears sudden, but the true collapse began months earlier. The 90-day window is the transformation period when resilience turns into fragility. It is the period when fundamentals fail, when liquidity evaporates, when credit weakens, when sentiment diverges from reality, and when institutions silently prepare for impact while the public remains unaware. It is a period defined not by noise, but by silence. Money exits quietly. Liquidity evaporates slowly. Confidence decays invisibly. Then, abruptly, everything catches up. This is why economic collapses always feel shocking. Not because they happen overnight, but because the world only recognizes the truth at the very end of the countdown. The real collapse, the one professionals see, begins long before the headlines report it. And if history is right, the next countdown may already be in motion.